Imagine this. You wake up one morning, scroll through the news, and see headlines flashing everywhere. Oil prices have just crossed $100 a barrel. This isn't just a number on a screen, it's a signal that life is about to get a lot more expensive. Suddenly, the price at the gas pump jumps overnight. The cost of that flight you were planning to book goes up. Even your weekly grocery bill starts to climb. Why? Because oil isn't just another commodity, it's the lifeblood of our global economy. From the fuel that powers our cars and planes to the plastics in our electronics and the energy that heats our homes, oil is woven into the very fabric of modern life. When its price surges, the shockwaves are felt in nearly every corner of the world. So, the big question on everyone's mind, from Wall Street analysts to everyday people, is this: could we really see $100 oil again? For a long time, it seemed like a distant memory, but now, that possibility is looking more and more real. To understand why, we need to look at a complex puzzle of global politics, economics, and market psychology. It's a story of powerful nations, tense conflicts, and the delicate balance of supply and demand that keeps our world running. Let us break down the forces that could push oil prices back into triple digits and what that would mean for all of us. One of the biggest drivers of oil price spikes has always been geopolitical tension, and right now, the Middle East is a major hotspot. This region is home to some of the world's largest oil producers, and any instability there sends shivers through the global energy market. A key area to watch is the Strait of Hormuz. This narrow waterway nestled between Iran and Oman is arguably the most important oil choke point on the planet. About 1/5 of the entire world's daily oil consumption passes through this strait. That's millions of barrels of crude oil and petroleum products on supertankers every single day. Now imagine if this critical route were to be disrupted. Conflicts involving regional powers like Iran or attacks on shipping could threaten the free flow of oil through this passage. Even the threat of a disruption is enough to make markets panic. Oil traders don't wait for a supply cut to actually happen. They react to the risk. The moment tensions escalate, they start bidding up the price of oil, factoring in the possibility that supplies could be cut off. This is why a single drone strike or a political standoff in the Middle East can cause oil prices to jump several dollars in a matter of hours. The market is pricing in a geopolitical risk premium, and the higher the tension, the higher that premium goes. If the Strait of Hormuz were ever to be closed, even for a short period, it would trigger a massive supply shock, and $100 oil would likely be just the starting point. But geopolitics is only one piece of the puzzle. The fundamental principles of supply and demand are just as crucial, and right now, they're also pointing towards higher prices. Let's start with the demand side. Despite the global push towards renewable energy, the world's thirst for oil hasn't gone away. In fact, global demand has remained surprisingly strong. Major economies from the United States to China and India continue to consume vast amounts of oil. Think about it. Our transportation sector is still overwhelmingly dependent on gasoline and diesel. The aviation industry relies entirely on jet fuel. Manufacturing processes, from creating fertilizers to producing plastics, all require petroleum-based products. As long as economies are growing, people are traveling, and goods are being shipped around the world, oil demand stays high. Even a slight increase in global economic growth can translate into a significant jump in the demand for oil. Now, let's look at the supply side. You might think that with high demand, oil producers would just pump more to meet it. But it's not that simple. In recent years, investment in new oil and gas projects has been constrained. Why? A combination of factors. Some energy companies have faced pressure from investors and governments to shift towards greener energy sources and reduce their carbon footprint. This has made them hesitant to pour billions of dollars into massive, long-term oil exploration projects. On top of that, major oil-producing groups like OPEC and its allies, often called OPEC+, have been carefully managing their production levels. OPEC Plus controls a huge portion of the world's oil supply, and they often agree to production cuts to keep prices stable and prevent a market glut. When they decide to hold back supply while global demand is strong, the market tightens. This means there's less spare capacity in the system. So if an unexpected disruption occurs somewhere else in the world, there isn't enough extra oil ready to fill the gap. This delicate balance between slowly growing supply and robust demand creates a situation where even small shocks can lead to large price spikes. The third major force at play is the financial market itself. Oil is one of the most heavily traded commodities in the world. It's not just oil companies buying and selling to manage their physical supplies. A huge volume of trading is done by speculators, hedge funds, investment banks, and other financial players who are betting on the future direction of oil prices. They use complex financial instruments like futures and options contracts to make these bets. This financial trading can amplify the price moves caused by real-world events. For example, when news breaks about rising tensions in the Middle East, thousands of traders might simultaneously rush to buy oil futures, hoping to profit from the expected price increase. This surge in buying can become a self-fulfilling prophecy, driving prices up even faster and further than the fundamentals alone would suggest. Similarly, if economic data suggests that global demand will be stronger than expected, speculators will pile in, pushing prices higher. This speculative activity adds another layer of volatility to the market. It means that oil prices are not just a reflection of physical supply and demand, but also of market sentiment, fear, and greed. The psychology of traders can be just as important as the number of barrels being pumped out of the ground. This combination of real-world supply constraints, geopolitical risk, and financial speculation creates a potent mix. Any one of these factors can push prices up, but when they all align, the path to $100 oil becomes much clearer. So what does it all mean for you and me? A return to $100 oil would have far-reaching consequences. The most immediate impact is at the gas station. Higher crude oil prices translate directly into higher gasoline and diesel prices, making every commute, delivery, and road trip more expensive. This hits household budgets hard and increases costs for businesses that rely on transportation, like trucking and delivery services. Those costs eventually get passed on to us, the consumers, in the form of higher prices for goods. The airline industry would also take a massive hit. Jet fuel is one of an airline's biggest expenses, so a surge in oil prices means more expensive plane tickets or new fuel surcharges. Vacation plans and business travel suddenly become a lot more costly. Beyond travel, our energy bills would likely rise. Many power plants still use oil and natural gas to generate electricity, so higher fuel costs mean higher utility bills. And the effects don't stop there. The cost of producing almost everything goes up. From the plastic packaging on our food to the asphalt on our roads, countless products are derived from petroleum. Higher oil prices mean higher manufacturing costs, which leads to inflation across the entire economy. Essentially, it acts like a tax on everything, slowing down economic growth as consumers and businesses cut back on spending to cope with rising costs. So, while the idea of $100 oil might seem like a distant economic headline, its effects are very real and very personal. It is a reminder of how interconnected our global energy system is and how vulnerable we are to events happening thousands of miles away. The combination of simmering geopolitical conflicts, a tight supply-demand balance, and supercharged financial markets has created a perfect storm. The question is no longer if oil could reach $100, but when it might happen and how prepared we'll be when it does. Thank you so much for watching. If you found this breakdown helpful, have you seen the headlines lately? Everyone's buzzing about whether oil could hit $100 a barrel. It's a huge number, and it gets people talking. But honestly, the more important question isn't just if it will happen, but what happens to all of us, to the entire global economy, if it does. Let's break it down. Historically, whenever oil prices have shot up suddenly, economic trouble hasn't been far behind. Think of it like this. High energy costs are basically a tax on everyone. When you see those gas prices climbing, every dollar you spend filling up your tank is a dollar you can't spend on other things, like going out to eat, buying new clothes, or saving up for a vacation. This reduction in spending, when multiplied across millions of people, can really slow down economic growth, which in many countries is driven by people like you and me buying stuff. And it's not just us feeling the pinch at the pump. Businesses get hit hard too. Imagine you're running a company. Suddenly it costs more to transport your goods. Airlines are paying a fortune for jet fuel. Factories need more money just to keep the lights on and machines running. What do all these businesses do? They don't just absorb those costs, they pass them on to us, the customers, in the form of higher prices. This is how a spike in oil prices can trigger a wave of inflation across the entire economy. Suddenly, it's not just gas that's more expensive. The price of your groceries goes up because it costs more to truck them to the store. The new t-shirt you wanted cost more because the factory's energy bills went up. It creates a ripple effect, making almost everything in our daily lives more expensive. Now, when inflation starts running hot, central banks like the Federal Reserve get nervous. Their main job is to keep prices stable. To cool things down, they might keep interest rates high or even raise them further. That makes it more expensive for people to get mortgages for a new home, for businesses to get loans to expand, and even raises the interest on your credit card balance. Higher borrowing costs put the brakes on spending and investment, slowing down the economy even more. Financial markets, of course, are watching all of this like a hawk. When oil prices surge, it's not all bad news for everyone on Wall Street. Energy companies, the ones pulling the oil out of the ground, can see their profits soar. Their stocks might do really well. But for other sectors, it's a different story. Airlines, trucking companies, and manufacturing industries often struggle with those ballooning costs. This can lead to a lot of volatility in the stock market as investors get anxious about future economic growth and company profits. In times of uncertainty and inflation fears, you might also see investors rushing to so-called safe haven assets like gold, which can push their prices up. But here is a crucial point. $100 oil doesn't automatically mean we're heading for a full-blown economic crisis. A lot depends on how long those high prices stick around. If it's just a temporary spike that lasts a few weeks, the economy can probably shake it off without too much long-term damage. But if oil stays expensive for months or even years, that's when the real pressure builds. The cumulative effect on inflation, consumer spending, and overall economic growth could become a major problem. The future of oil prices is a really complex puzzle. It's influenced by geopolitics, supply decisions from major producers like OPEC, global demand trends as economies grow or shrink, and just plain old investor sentiment. But one thing is absolutely clear. Energy is at the very heart of our modern world. It affects everything from how we get to work to the price of food on our shelves. So when oil prices make a big move, up or down, the entire global economy feels the ripple effect. It's a story we all need to keep an eye on. Thanks for watching. And if you found this breakdown helpful, be sure to subscribe for more content just like this.